secret stash.
That's super secret!
And this is the only show that tracks down the local people behind the places and things we love.
I'm gonna kick it off with my favorite thing ever.
Then goes deep to reveal the best kept secrets behind them all.
Why aren't we talking to people? Let them know. Shout the rooftops. This is great.
And leave you with a stash of stories and offers you'll only find here. Now, here's your host, Jesse Ibañez.
Secret agent man, secret agent man. They've given you a number and taken away your name.
What's happening, gang? I'm the secret agent man, Jesse Ibañez, co-founder of the GreenHouse Group and Real Talk Radio San Diego, and you are live in the secret stash, baby. What does that mean? Well, we got some cool local people doing some cool local things, tracking down some of their best kept secrets, and who knows, maybe even grabbing a story or two about them in the process. And in the studio live for the 11 o'clock hour, I'm flanked with some pretty familiar faces. I think I've actually been following both of your careers. And of course, I'm talking about my man Jeremy Beck, co-founder also of the GreenHouse Group, head of the mortgage planning wing of things. What's up, my man?
Hey-o. That's my thing.
That is your thing, isn't that? That's Ed McMahon's thing, I think, isn't it?
Yeah. It's
Are you going to like pay him his royalty?
It's a second man sort of thing.
And flanked to your right, also a familiar face, my man, partner at the GreenHouse Group as well, mortgage planning division, aficionado, affectionaire. I think I just made that word up.
Yep.
David Hughson, ladies and gentlemen, what's
Huggy
happening?
Bear.
Thank you for having me. It's good to be here.
You bet, man. So you guys are going to be ganging up on me today. It's 2 versus 1. And what I would love to expose over the course of the next 60 minutes, if I might, is in part what we want to call the real estate game 2.0. What in the world does that mean? Well, first of all, if you have bought a home ever before, and maybe you haven't either, maybe you even haven't ever bought a home before, but at least you haven't done any transacting in the last, what would you guys say, about 36 months? I would say
that seems fair.
Most of the game has changed. And that couldn't even be more true than right now, because now we have all these like external factors crunching in, like the fact that the rates are really low if you're thinking about buying, or if you're thinking about selling, how that is going to affect your purchase price as well, where prices are going, the context of competition, a low inventory. There's so much inside that container. And man, do you need a guide by your side right now more than ever? And so luckily we're flanked by two of the best in the financing component of things. And I'd like to believe I can hold my own in the context of how to get into and out of the homes in the process. But let's get this party started right now. Jay, I'll start with you. What would you say right now is the biggest challenge in the real estate game, the reason why we need a 2.0 in the first place?
You mentioned something that I think is really important, and that's the constant evolution of the process. And Dave and I were just on the way over here to the show and noticed that there are things that have changed in the last 12 months that are substantially impactful in the buying process, at least from the financing side, specifically loan amount maximums.
Okay.
So, we could talk a little bit about that probably later, but the idea that it's always a moving target, and how you structure your loan is imperative on how much it costs you over the life of that owning that home.
Yeah, and I also would throw in there with rising prices, it's almost like it's a laggard, right? They're always trying to catch up to where things are right now. So when you're looking at how much you can borrow and then the corollary, I think I just picked this up recently, and I forgive me if I'm wrong, but did I see that the median home price in San Diego is back up at over $500,000?
I heard that.
That's right.
You know what I'm saying? That happened fast, yo.
Yeah, it did.
I remember when it was kind of back like that, when it was all crazy, like 06, I think was the last peak, and then it just fell off the face. And I think
prices cut in half.
Yeah. In some areas, they were literally in half.
Yeah.
And then, so now we're back up. I mean, do you think that's sustained, first of all? I mean, because I know I've heard you guys talk about in the past that, this time it's okay because they're actually qualifying you on having a job. You actually have to have a job now. Imagine that, right? It's not just like your FICO score and that you fogged a glass.
Yeah.
In your breathing. So, do you sustained or a mini bubble? What do you guys think?
Well, I think when you talk about real estate being a localized phenomenon and you talk about the constant evolution, loan programs or loan volume, I should say, is, I think, the biggest fluctuating factor, meaning we've had rates go up in 2013, which killed loan volume. And recently, with loan volume way down, lenders are looking for any way to lend more money.
Mm-hmm.
So they throw out these little enhancements here and there. And now we're seeing low inventory to the point where it's kind of a frenzy out there for some of our buyers. And now these lenders are a little short-staffed and turn times are going up.
Mm-hmm.
So I think that,
another laggard right there.
Mm-hmm.
Yeah.
And it's because exactly that. We have people now catching up to the news that was the news back in January and February, which were rates were at all-time lows back to where they were in the spring of 2013.
Yeah.
And now we've got buyers and even people looking to refinance that are having to deal with extended turn times. And but the loan programs are slowly, we've seen some big improvements in some categories, but for the most part, these are tiny enhancements. But the point is that whether you are buying, I think it all starts with doing the heavy lifting in the beginning, making sure you hit the ground running as opposed to getting out there ahead of yourself, which...
Yeah. Let me hit a couple examples of the things Dave was talking about. I know he's prepared to talk about loan program expansions. And so one way that the financial institutions are keeping up with the ever-changing environment is you either see them shrinking what products are available, or you see them expanding what products are available. In this case, I know Dave is prepared to talk a little bit about combo products, a first and a second at the same time.
Oh, that's right.
Man, those went away as soon as the market crashed, right? So they're back.
Yeah, don't drop that yet. I got a whole we'll tease on that because that's something we want to hit on later.
Yep. So that we can talk about where rates are. When you talk about, is this sustainable? In some ways, this is a perfect storm.
Okay.
Again, right now, the benefit is that buyers are qualifying. So you actually have to, generally speaking, be able to afford the property that you're paying for. So in that way, prices aren't going up artificially.
Okay.
But you've got low rates. You've got all kinds of program enhancements. You've got 3.5% down. You have all this
You even
stuff.
got 3% down now.
3% down potentially. So,
Yeah.
you have all these things that are helping people buy properties now. As long as those stay true, sustainability seems reasonable.
Yeah, I love that thought. And I don't want to get too far into the weeds right now, but I love the fact that we're sort of trying to keep this primer at the 30,000 foot. You talked about things like loan limits and that there's different varying castes almost, right? So you want to be ideally in the conforming because that's where you get to pick right off the rate sheet. And what is that up to right now? 417?
That's 562.
Oh, okay.
562,350 now.
So that's not the high conforming. That's the
high conforming.
That's the high conforming. What's the one that's not high conforming?
417.
Right? 417. Then you got the high conforming up to
562.
562. And then what happens after that?
Then you're in non-conforming or jumbo
and
products.
The jumbo, right?
Yeah.
And how far did jumbo goes up into the high, tall sevens,
Whatever.
right? Yeah.
Lender specific at that point.
Lender specific at that point. You're just quoting off. And so, but that's a big deal because, for example, what's the difference? I know you're not going to quote off all the different lenders' rate sheets right now, but typically speaking, between just conforming at 417 and then jumping up into the high conforming, like there's a cost to that.
Yeah.
That's a corollary to risk, right?
You know that off the top of your head, Dave?
It's about a quarter.
Yeah.
About a quarter
That'd
percent.
be my guess.
Which normally is like, dude, who wants that? But when the rates are starting at what right now?
Mid threes.
That's what I'm saying, dude, right? So this is funny money, is it not? I mean, this is like landing on the little free parking thing at the Monopoly board and grabbing all the 500s off. So would you say that there's a lot of buyers right now that are trying to find homes? Trying to find places to almost park these loans is kind of like what it is, right?
Yeah.
More buyers
exactly.
than homes available. That's one thing that I want to riff on here as well is what do you think is going to spawn the inventory for sellers to come back around and get us closer to homeostasis? I mean, all these products are out there. They're all kicking butt. The rates are insane. We have the buyer pool. Why aren't the sellers, if the median price is at $500,000 or whatever, why aren't they jumping all in the market?
My first response would be because they bought too recently.
They just don't have enough equity still.
Well, either that or they see home values going up and they'd rather ride it out a little bit and see what their home would be worth in 6 months as opposed, or maybe in another year, especially if they've bought in the last, 36 months.
But there's a dark side to that too, though, right? I mean, do you think the rates are going to stay at 3.5%, Dave?
No, I don't.
They're probably going to be popping up, right? I mean, they can't stay down this long.
They can't
for
go any
that
lower.
long, right?
There's only one way to go.
So when rates go up, what happens, of course, to buyers' purchase power?
Yeah, it's cost.
Right? And they're not making more money at their job to offset that, or they have a rich uncle infusing their down payment to offset that. Then what happens? That means their qualifications go down, and the whole thing sort of shifts and adjusts accordingly, does it not?
Yes, absolutely.
So why would a seller wait in the fence?
Well, the reasons for that are going to be individual to everybody out there,
Sure.
of course. In general, I don't know why they would wait. I mean, it is a good time. I'm even considering this for myself, and I'm basing it simply on what the market is doing right now.
Right.
So, but I think it really does come down to the individual and what their individual reason is.
Which it always does, right?
think-
But we're staying 30,000 foot just to make an easy point right now.
Yeah.
Yeah.
And the easy point is that I don't know, like you.
That's what I'm saying, man. Yeah,
I
Jer.
can speak from personal experience when we were moving from our last home to this home, and the market was so tumultuous and prices just kept getting higher. The concept for us was, okay, yeah, we can sell our place for a ton of loot, but what do we buy next? How much more do we have to go up to improve our situation? I think you start looking at that and you see these jumps in the particular areas. You might have to go up another $100K on your next purchase to really improve your situation if you're selling and then buying in the same market.
Yeah.
I think that's actually a perfect opportunity to take a quick stop on that conversation, only because coming up, we're going to get in the weeds, gentlemen, here, and I hope you don't mind me throwing you in the hot seat here with your financial wisdom caps on. We're going to talk about that seller. We're going to talk about how if you're in that conversation right now, even with yourself, you haven't even raised your hand yet for help, and you're saying, hey, I wouldn't mind cashing in on what I got right now and doing a move out, but then what? So we're going to call that the sell then buy paradigm. And then if you're on the other side of that coin and you're a buyer and you want to lock in these rates at 3.5 before they start creeping up, or the down payment and all this different great stuff going on for buyers, what am I going to do to be able to beat out the other 10 offers that are maybe lined up outside the open house before I even get their first hour on the market? And then you guys are going to drop some knowledge about some crazy programs. All that stuff's going to be live in the stash for your next 47 minutes, gang. So thank you for hanging out. This is Real Talk Radio San Diego. I'm flanked by Jeremy Beck of the GreenHouse Group Mortgage Planner and David Hughson, GreenHouse Group as well. You can catch them both at 858-863-0261. Again, that's 858-863-0261. We'll be right back.
Put your hands in the air.
You're listening to The Secret Stash with host Jesse Ibañez on ESPN Radio 1700.
What's happening, gang? You are live in The Secret Stash. That means we got some cool local people doing some cool local things right here live on your ESPN Radio 1700. Real Talk Radio San Diego. And we talking some real stuff right now. We talking real estate with two guys that know that domain and that conversation better than anybody I know. And that's why they're flanked also as partners in the GreenHouse Group. I'm talking about co-founder Jeremy Beck, mortgage planner aficionado.
Thanks, buddy.
They're going to catch you live where? You're going to go 858-863-0261, right?
2.
Yeah, same thing, man. All lines point to Jeremy, basically, is what it comes down to. And then I got Dave Hughson as well. Dave is David at greenmeansgrow.com.
That's right.
Green means grow. What do you guys do over there? It's kind of an awkward.
It's weird.
Yeah.
You doing marijuana or something?
It is.
Green means grow. Right, Dave? Clean that up.
You want me to okay.
Yeah.
Right. It is not a collective.
Right.
It is a collection
Yes.
of like-minded people.
Yeah. Doing real estate. Helping folks get into and out of homes. My man from Amsterdam, who's probably not even from Amsterdam.
No.
I want you to get us back on track, Dave. Okay? Right before the break, we were talking about that context of we need more inventory. We have incredible programs right now for folks to get into homes. They can come in with less down right now than we've ever seen before. 3.5 was always like, oh my God, FHA, 3.5% down. That's great. Housing Administration, basically subsidizing first-time buyers. Then Fannie Mae got on board and they're like, hey man, we'll one-up you. How about only 3% down? And it's you don't even have to pay for mortgage. It's lender-paid mortgage insurance, right? They cook it into the rate.
That's correct.
That's insanity. So what for a $500,000 home, which is what we're talking about is the median price right now, 15 grand down, a couple extra bucks for some closing costs. What are you in a home for about 20, including everything? Maybe 25, 23?
20 to 22.
Yeah.
Yeah, absolutely.
That's insanity for a $500,000 home. And a payment right now you can probably afford because the rates are so low. You were saying they were trending somewhere around 3.5% right now.
Yeah, absolutely. The mortgage insurance that has been around now, most people don't think of a market now without mortgage insurance,
right?
Because back in 2008, when the market shifted and they got rid of second loans, everybody now has to pay mortgage insurance, whether it's FHA or conventional.
Right.
And
if you're bringing in less than 20% down is the point you're making.
That's correct.
Right.
Yeah, that's an important point. So what we found, though, is that there are lender-paid mortgage insurance options, and they've actually been around for quite some time.
Which means basically no mortgage insurance to the borrower.
Right, and like you said, it's part of the rate.
So what, they pump up the rate. Let's say you qualified for 3.5. What do they give you, like 3.75 instead or something like that?
No, meaning, you're partly right. So what's been going on up until this last year is that the lender-paid mortgage insurance option meant taking a rate that was maybe 7/8 to a full point worse.
Oh, wow.
So it was not a viable option. But in the last 6 months, lender-paid mortgage insurance, the gap between that and the borrower-paid has diminished greatly. So now you're right. We're about a quarter difference.
That's insane. Mm-hmm. And so how does that work? Like once you get one of those products, like is it there forever? Well, like, is it bolted on forever? Or can you like get rid of it at a certain point in time if you get equity in your house? Like how's that work?
Well, the lender-paid mortgage insurance option means that it's part of the rate, and the rate is always there, so it's always bolted onto the loan.
So the lender-paid's kind of like, it's equivocal to Lady Gaga Bad Romance. Okay, so what's the other one like? And you have to match it with a song, otherwise you don't get out of this hot seat.
Do you agree with that statement?
I still don't know what that means.
Just keep it rolling.
Okay, so the conventional option with private mortgage insurance, it means that the mortgage insurance will cancel automatically once the loan reaches 78% of the original appraised value.
So how do you have to prove that? Do you have to actually, original appraised value?
Right.
Oh, wow.
Now that's the automatic termination.
Yeah.
There is a borrower requested termination as well. And that means you have to pay on the mortgage insurance for a minimum of 2 years. Mm-hmm. And then at your expense, meaning you order the appraisal, you can request that the mortgage insurance be canceled. Now you must be at an 80% loan to value in that scenario.
That's actually cool. So that's if the market's maybe pumping up a little bit. You're like, hey man, I got some traction on this. I'm going to go pay $450 or whatever for an appraisal, prove it to my lender, and then you're, who knows, $200-300 maybe more dollar mortgage insurance payment just disappears.
Yeah. Right. So if you're not putting down just the minimum, where your PMI cancellation would be further down the road, it's not always a bad idea to take on the mortgage insurance.
Yeah.
I got a take on this.
Yeah.
So I think the lenders have become more aggressive with this because of two reasons. One, they believe in equity. So it's less of a risk. Remember, rate is just a translation of the risk that the lenders are taking on. And so by saying, okay, you don't pay for the mortgage insurance, we'll do it, they bolt it onto the rate. One, they can sell that loan for more. Two, there's more interest to accumulate over time. And three, it speaks to the fact that they believe in the property. If they didn't, they wouldn't do that. So I think that lenders, generally speaking, and they may not be have the greatest track record of foresight over profit, but the idea is that maybe they're seeing something in the stability of the equity. I also think that there's an interesting thing that happens when you get lender-paid mortgage insurance. Yeah. In other words, you just take a higher rate, don't pay mortgage insurance. The payment's actually lower in the beginning. But you said something. The rate, and Dave said this, the rate is with you for the life of the loan.
Right.
Okay? So in the beginning, it's cheaper. Over time, it's more expensive.
Assuming rates go up, you mean?
No, not at all. So in the beginning, it's cheaper compared to lender-paid mortgage insurance. Okay, or borrower-paid, excuse me. So if you pay your own mortgage insurance, it's more expensive because you've got a lower rate, but you have this bolt-on payment. Mm-hmm. In the lender-paid mortgage insurance, where it doesn't feel like you have mortgage insurance, you're taking a higher rate. If you put those two side by side in the very beginning, most people take the lender-paid because it's a lower payment. It's a lower payment in the beginning.
Right.
But the cost over the life of the loan is higher. And so where the strategy comes in is calculating exactly where that trade-off is and determining what suits you best.
Yeah.
Because if I know I can get rid of that borrower-paid mortgage insurance component and then be left with a lower rate over the life of the loan, I could win in the end. But how long? How long does it take me to do that? What's the math? And that's what we've become accustomed to with helping people.
And I love that context, too, because when you say you're a mortgage planner, how many people look at you kind of cockeyed like, I heard the word mortgage. That sounds familiar, but I don't know what the rest of it means. That's exactly. So it's almost like if a loan officer is on one side of the spectrum where they're just order takers. You can walk in, you can hit them up at a fancy desk at your bank, and they just prescribe you like a rate off of the sheet.
Right.
And then you're lucky if it closes kind of thing, right? Whereas a mortgage planner is on the other side of the spectrum where they look at the entire pecuniary profile of the borrower. What are your goals? Reverse engineer those backwards. I know not everybody has a magic ball, a crystal ball, and they know, I'm going to stay in this home for exactly 7.25 years. Or, a lot of military folks, I know I'm going to get my papers, I'm going to move in 3. That's almost impossible. But the truth is, if you look at the stats, and especially for first-time home buyers, which you guys specialize in, I know in San Diego County, what's the average amount of time someone's in their first home? Come on. 5 years at the most?
Yeah.
Right?
Yeah.
It's usually a starter while you're growing lifestyle, you're growing a family, you're growing wealth basis, you're establishing yourself in the professional context. All of those things usually end up manifesting in switching up addresses every so often, right? So that's a critical part of your strategy session when you're sitting down. Maybe the lender paid makes more sense because they know they're not going to be in there for more than 3 to 5 years.
Right.
And not to mention the lender paid model up front can boost your purchase power too.
That's another thing too. I'm glad you brought that up. Not probably like a panacea. It's not going to jump you $100,000, but it could be the difference if you're trying to stretch your money goal right now. I mean, come on, we're seeing multiple offers on properties. We're seeing some people have to kind of get, okay, fine, I'll do the extra $5,000 if it's for this property because it's the perfect property. That might be the difference of whether they can get that home or not if you go lender paid versus borrower paid.
And that's almost always the case in my experience because they're not $100,000 away. They're $5,000 away.
Right.
They're $15,000 away.
Right.
And that lender paid model gets them exactly that amount, if not oftentimes more.
Yeah. So how does that process work? So, I mean, I've heard people much smarter than me say right now that the wisdom is to beg, borrow, and steal to get your name on as much home as possible right now, not even talking about or speaking into what's going to happen with prices, more so just about the rates. Right. And I know everybody has a healthy relationship with the rates, but I think what's more true than that is people are living in a false reality about how low things are right now and what that means. Like, we've been down in this weird, 5%, 3% purgatory for so long. People are starting to think this is the new norm. This is not the new norm.
It's so funny
when my dad bought his first home, he got a rate for 13.5%.
Yeah.
So it's like, it's more about that, right, than it is necessarily even about like picking the market perfect with the price, or even if it goes down a little bit, there's still indemnity just because you locked in at 3.5%.
Yeah, we meet with a lot of first-time home buyers, and they come in with that perspective. And, let's say that they're, for whatever reason, maybe they got some credit issues. They creep up into the high 3s, maybe low 4s, whatever that is. And they're like, 4%. Like, like they can't believe their rate's so high.
Yeah.
And, I let them know we're going to laugh.
Yeah.
This is a joke right now.
Yeah. Yeah. Well said, my man. Hey, and I love that also as a lead-in to what I want to hit on next. And I know you guys came prepared to bring the heat with some programs and some numbers and stuff. And I also love the thought that I'm going to be contributing with probably my 2 best strategies. One for a buyer who wants to sell then, one for a seller that wants to sell then buy, and one for a buyer that wants to beat out all the multiple offers out there right now in San Diego County as we heat up for the summer months. So coming up, we're going to do just that. I got my man David Hughson, mortgage planner at the GreenHouse Group. It's David at greenmeansgrow.com. And I got Jeremy Beck, co-founder of the GreenHouse Group. You can catch him at 858-863-0261. We'll be right back.
Hi, Hi, it's Courtney with 5-Star Escrow. If you provide 5-star service, your escrow company should too. When you need fast, friendly, and accurate service, think 5-Star Escrow. We're the escrow company of choice for the Friends of Real Talk San Diego, and we're committed to delivering a first-class experience when you need it most, at closing. Why settle for less? 5-Star Escrow, getting your transactions closed and getting you paid on time. Visit us at 5starescrow.com. That's 5starescrow.com.
I'm gonna love it until you hate me.
You're listening to The Secret Stash with host Jesse Ibañez on ESPN Radio 1700.
What's happening, gang? You are riding live in the stash. My name is Jesse Ibañez. I'm the host of this, co-founder of the GreenHouse group, tracking down some of the coolest local people, doing some of the coolest local stuff. And I think I fit the bill pretty well today with some familiar faces. We're actually talking real estate game for Real Talk Radio San Diego with my man Jeremy Beck, co-founder of the GreenHouse group, mortgage planner, and David Hughson with the same title. But, you know, one thing I'd like to catch on, though, Dave, I know you brought some numbers I wanted to share about. We were riffing on the whole lender paid, borrower paid context in the last segment. Before I jump into my biggest gift I'm going to give to all you sellers out there who are thinking, is this the time or not? I got a gift for you. But, Dave, finish out that cognitive loop we were hitting on last time. What are some payment examples of those two different programs, lender paid, borrower paid?
Okay, just for a minute, you know, as I mentioned earlier, lenders are looking for any way to enhance lending guidelines, and most of these are very small.
Okay.
For example, a small enhancement would be for borrowers who need gift funds from a family member for down payment. Now, the donor only needs to wire the money directly to escrow. They do not need to provide documentation in the form of bank statements to the lender that's underwriting the loan.
Now, that's so funny, too, because if someone's hearing that without context, they're like, big deal. But, dude, how funny is it that a lot of parents and relatives, they hate that stuff, don't they? They're like, I don't want the lender seeing my stuff. It's crazy.
Exactly right.
How many times I've watched that actually try to blow up a deal.
They want to provide the money. They want to do the right thing by their kid, but they don't want to be exposed, so to speak.
Yeah.
You know, and
Big brother. Right. Yeah. Yeah, good. So please continue.
All right. So that's an example of a small enhancement. Now, one big one that I think the biggest one we've got going right now is that the return of second loans, meaning these are loans that are in second position.
First and second, combo loans.
Loans, right? So to give you a little perspective, the last time we were doing combo loans, Jeremy was in his 30s, and you were single with no kids. So we're talking a long time ago.
Dave.
Okay, so combo loans are back, which means that we can do a first loan at 80% financing. That's 80% loan to value.
So that you get the ideal first loan, right? Because anytime you go over 80, it gets more expensive.
And we can do a second loan, and this for purchases, this would be up to a 90% loan to value.
Okay, not bad.
So you still need 10%.
Still need 10%.
But for those who have 10%, and this is a decent amount of people out there. This avoids the mortgage insurance conversation.
Yeah, and that's a big thing, too. So if you had the option, right, let's say you could qualify for one of these combo loans, right? You had 10% to put down. Or the other option is you could put 90% down, one loan, but then get mortgage insurance. Like, how would you know which one of those two is better?
Okay, so
That's one part of the conversation, Dave, before you get into that. The other part of the conversation is the combo loan allows you to expand past conventional loan limits. So that's a second interesting component. So you're talking about mortgage insurance versus no mortgage insurance by using the combo loan. But the other component is, hey, what if I want my first loan to go up to $562,000 and then I still want to borrow beyond that without becoming jumbo? So that's another use of this product. And we're not going to hit on that, but I wanted to share that because you guys brought it up.
That's a good strategy right now. Yeah, good.
Well, the example I give is exactly actually that scenario.
Okay.
So we, as you mentioned earlier, we have a $417,000 loan limit.
Yeah.
And this, by the way, works for the lower loan amounts.
Yeah.
So if we have a $417 loan and limit, then we have the high balance that Jeremy mentioned, which is $562,350.
Yeah.
So using an example of a $625,000 home purchase, which is a lot of homes in this county. We're a high-cost county, right? So we would do a first loan of $500,000
Okay.
and a second loan of $62,500, right?
Okay.
Now, we still can finance that same purchase with one loan with private mortgage insurance and one loan without private mortgage insurance. So you have three options. Which one's the best? Well, the combo financing on that $625 purchase price nets to a $270 per month less house payment.
So basically what I'm understanding then as the lay person is that it has to do with the rate on that second. The rate on that second piece, which in this case, in your example, is 10% of the purchase price, is less than the mortgage insurance would have cost the borrower.
Right.
Right? So is that just because it's a moment in time because the rates are so aggressive right now? Is that kind of a moving target that's going to change over time? So it depends from scenario to scenario?
Well, it will depend on the scenario, but the second loan that I'm using in my example is a fixed second. It's a 30-year fixed, just like the first.
Just
loan.
like the first.
So it's not a home equity line, or there's no.
So there's no variability to it, but there's higher risk, so it's going to be a little bit higher of a rate, correct?
Right, but guess what the rate I'm using is, and this is a very realistic rate, is 4.375, and that's for a second loan.
What?
That's a first loan interest rate. So.
Is that the right button?
That was Chris Tucker. He's just in the other room.
Oh, okay. Apparently.
He heard you and wanted to chime in.
Okay, so the 30-year option with the PMI is the highest option. It's the highest payment option. Now, as Jeremy mentioned, eventually that PMI will drop off and you'll have a lower rate, a lower payment. But if, given the statistical averages that we'd mentioned earlier, the combo loan, I think, is the superior option.
Incredible right now.
One of the other reasons why that plays out to be a lower payment is, remember, the accelerated or the higher interest rate is only on the second. So in Dave's example, I think he said $62,000. When you're dealing with mortgage insurance, it's on the entire sum. So that would be $560,000.
Interesting.
So you're paying mortgage insurance on the whole amount, not just the risky part.
Yeah.
That's where the big payment difference comes into play.
Super interesting. And some high-level stuff, man. That's what we're talking about. The context or the juxtapose of having just a loan officer. God bless loan officers. We're not trying to, browbeat them here. But, there's something that is to be said about, someone's been holding down this chair in this conversation for the last 15 years, who does this full-time, has had hundreds and hundreds of different experiences they can draw from, and is on the cutting edge of all these different programs, and then has the experiential capital to tie them into to make sure that you are getting to your destination on time safely, first of all, but then utilizing strategy and different products to make sure that you're arriving there as cheap as humanly possible. And I love that thought. So thank you for that contribution.
So one critical component, you're mentioning the label that we use as a mortgage planner versus loan officer or whatever you want to call it. The title almost doesn't matter. It's how we do what we do that I think is important. So as a philosophy, as a culture in the GreenHouse group, we make it imperative that the client come in and meet with us. We carve out 1 hour to meet with every new client.
Yeah.
An hour. So we're finding out what's important to them. We're finding out what ways we can do this. We're tweaking programs. And we operate as a broker, which allows us to have the largest exposure to a number of different lenders and products, as opposed to retail where they're stuck with just one.
And it doesn't cost you any different, which is
the same.
Someone hears that like, oh, okay, well, that's the fancy Ritz-Carlton version. No. You get paid the same.
That's right.
Or I should say from the buyer or the borrower's perspective, it costs you the same. So I love that thought. So real quick, the context that I want to hit with you guys real quick is that right now the market is hot like lava. Okay, we had an open house last weekend, and before I got there to set the signs up of this adorable condo
that picture.
Right off of Adams over there in University Heights, there was literally a line of people outside. I had to rub my eyes and see if it was 2013 all over again. And that's good. That means that people are excited about trying to purchase a home. The challenge, of course, that we spent earlier is that there's not a lot of inventory, which leads to multiple offer situations, right? So we're talking about these incredible programs you've got. The rates are really low. You can tweak, you can use strategy, all this different stuff. But how are you going to get the offer accepted in the first place to be able to even utilize those loans and lock in those low rates?
That's a good question.
Yep.
So one of the things that we talk about at the home buyer class, right, which, by the way, if you're even thinking about this being something that you want to partake in, I'm going to share something with you right now. Hopefully it's speaking through channels of wisdom beyond your own experience. You've got to get as much education as possible. Do not go in there, bump into the first open house you go to, make an offer, and think that process is going to go well. Would you not agree, Dave, that your ideal client meets you at least 6 months before they're even thinking about buying?
Oh, yeah. I mean, it is vital. To put that actual mortgage plan in place, to actually, that initial consultation is just where most of the work is done, I think.
Absolutely. And one of the things that you talk about in your homebuyer class, which, by the way, is free, and they can go to freehomebuyerclass.webs, right, WEBS.com, to sign up for your next one. You hold one arbitrarily every Wednesday evening down at the GreenHouse Group headquarters.
That's right.
So if you're in the market right now, think about being in the market, or maybe you're already in the market and you're like, hey, this ain't going the way I thought it should go, might be an opportunity to get a little injection into your plan and see if Dave and the GreenHouse Group can inspire you a little bit better. But one of the things you talk about in that class is how to get your offer accepted. This is one of the things I helped you with right now. So it's like real-time infusion on what do you do when there's 5 other people? You know, how do you make yourself look if you're not all cash? You know, or you're only bringing 3% into the conversation. What are the little tips and tricks? And the one thing that we do at the GreenHouse Group is we talk about a thing called the Buyer's Blueprint, which is a series of 5 things. Yeah, we actually make you work. Mm-hmm. We actually make you contribute to the conversation as much as an effort as we're putting into with 5 items. And trust me when I say you're going to want to know what those 5 items are. They are also the reason why an extremely ridiculous high percent of our offers get accepted. It has a lot to do with the communication. It has a lot to do with the little secret sauce that we sprinkle on that makes your offer irresistible to the seller. Because at the end of the day, even though there's multiple offers, this is still a belly-to-belly conversation. And you better believe they want to know who they're leaving their legacy of their home to. They want to get tied into that story. They want to believe in the fact that there was more of an exchange of just addresses. It was between 2 people. So I'll leave that as a tease also along with that web address. You're going to want to get that information. It's free, homebuyerclass.webs.com. And coming up, the biggest, greatest gift I could possibly give to you home sellers out there that are thinking about now being the time to cash in while moving out. We'll be right back. Real Talk Radio San Diego. You are live in the stash.
Hi, it's Courtney with 5 Star Escrow. If you provide 5-star service, your escrow company should too. When you need fast, friendly, and accurate service, think 5 Star Escrow. We're the escrow company of choice for the Friends of Real Talk San Diego, and we're committed to delivering a first-class experience when you need it most. At closing, why settle for less? 5 Star Escrow, getting your transactions closed and getting you paid on time. Visit us at 5starescrow.com. That's 5starescrow.com.
You're listening to The Secret Stash with host Jesse Ibañez on ESPN Radio 1700.
What's happening, gang? You are riding live in The Secret Stash. We got you here on Real Talk Radio San Diego. Talking about the real estate game 2.0, roundtabling with 2 of the minds that I think are the penultimate. There's got to be somebody better than you, right?
I mean, I guess. I'll take that.
Penultimate. No, Dave, you are the ultimate. Dave is the ultimate, apparently.
Roots.
There you go. Yeah.
The roots.
There you go. There you go. That's right. So we've been talking about this real estate game 2.0 in the fashion that, man, all of the rules have recently changed. So if you haven't bought or sold a home in maybe the last, 36 months, gang, you know, there's a whole different ball game being played. And so a lot of it has to do with strategy, swimming a little further upstream than maybe what you thought was right. Maybe if you're a home buyer, attending Dave's free home buyer workshop that he has every Wednesday night. And you can check that out by going to freehomebuyerworkshop.webs.com, right, Dave?
That's correct.
Yeah, and he'll reserve a seat. He'll share with you all of the 5 secrets that I teased earlier about the Buyer's Blueprint, and then all kinds of other stuff that you didn't even know. And we were just wrapping out in the break, actually. Before I hit on the seller thing, Jer, what's the you were saying that, hey, there's a cost to the rate if you wait. I think you had like a little Johnny Cochran ring to it, right?
Yeah.
Yeah, so maybe you could round out that part of the conversation with that share.
So let's check this out. And here's the thing: if you some people are on the sidelines, they know rates are low, they know things cheap. But what if I don't want to buy right now because I think prices are high? Maybe I want to let them go down a little bit. Well, there's a potential cost for waiting. I mean, if you look at what people are talking about in the environment, there's only one way for these to go, and that's up. So what happens if they go up? Let's give you an example. Dave was talking about $562,000, so let's stick with that. A payment at 4%, which is conservative for now. You can probably even do better than that. $2,683 a month.
Okay.
For the loan only. $2,683 a month. At 5%, it's $3,016. That's $333 a month difference. So if you just waited, you ended up buying the same home at the same price, and rates were a percentage point higher, 5%, which is still below the historical averages. $333 a month more.
And you don't even have to protract that out. So what I love is if you flip that around, use that same math. Would you say it's safe to kind of assume that every $100 is going to cost you about what 15 to 20 grand in purchase power?
Yes, that's right.
So let's just use 20. So that's 60. That's $70,000 in purchase power.
Right.
Right. And I know you got to check that math, right? But this is just kind of get you into the ballpark right there. So it's like, it's not just about that. It's also about the fact that, dude, good luck going out there and looking at $560,000 homes, and then all of a sudden the rates go up a point, and now you're looking at the $490,000 home. That's about as much fun as death at a birthday party.
And you're going to know this as a realtor. Do sellers like to come down on their price just because money is more expensive?
Oh, they love that. It's their favorite thing to do.
I mean, that's what I'm saying. Like, so if I'm in this market right now and I'm a seller and I think I can get $562,000 for my home, and then next year you come to me and you say, well, you know what, rates went up, so you probably don't get as much.
Which is probably going to be true. Let's be honest. I mean, there's causal effects to all that stuff, and I think you'd be silly not to say that there's going to be some type of, we watched that in 2013 when the same thing happened, Dave. We were, in 1 week, I think the rates went up by like 1 point and the market stopped. So if you didn't need to sell your home, that's cool. You go sit in the sidelines. But for the rest of them that did, guess what? They had to drop their prices a little bit.
Yep.
So that's to happen too. So
let me tell you this then. So let's say that you waited, and next year rates are 5%. And let's lower the purchase price down $50,000.
Okay.
So let's say you got that same home.
Okay.
Instead of $562, your loan's $502.
Okay.
$512.
So you're like, dude, victory, awesome. Yeah.
I got it for $512.
Yeah.
But your rate's 5%.
Yeah.
Your payment's $27.48 as opposed to $26.83.
So it's still
previously.
Still what, $60 or whatever?
It's higher.
Yeah.
It's still higher, even though the prices went down 10%.
And that dovetails on a point we made earlier about how the rate is really what's king right now. Even if the prices fluctuate a little bit, it's going to hurt your ego.
Yeah.
But when you protract that out, even on an immediate basis, even if it's dropped 50 grand, you're still paying more.
From a seller perspective, that's just as interesting, right?
Yeah, and that's actually a great segue. So what I'm finding right now to be true, and if any of you right now are listening to this message for the first time and you're finding yourself inside these shoes, I implore you, I actually started a seminar to address this conversation, because so many people that I've been talking to are in that frozen fear state where they've got their home, they are knowing that it's worth like what they always hoped it was, like what it was back in 2006, and they really want to make a move, but they're scared to death. Why? Because then what? Where do they go? Right? So if it's an empty nester, you're thinking, okay, well, I want to downsize, but they're looking on the market right now. They're probably on one of those free sites out there that you shop for homes, and they're not finding anything that they'd like, Or it's the other side where you're like, man, I want to try to trade in my home right now and move on up because I got a new kid or made some more money in my job or whatever the case may be, whatever the context is, or you just want to get into a different market, different lifestyle. There's so much integrated complexity when you have buyers that are waiting outside your home to write offers. How do you know you're not going to be left on the sideline with nowhere to live? Right? I mean, you can just feel that, like it's the chiver.
Yeah.
Right? So there is a series of 7.5, I would call them absolutely non-negotiable points. You could say forward-stroke strategies, put them in whatever bucket you can, that I've learned over the last 6 months about how to navigate this conversation. And I actually created a container called Little Workshop. And I'm willing to do this, just like you, Dave, for once a week, we're going to be opening up the GreenHouse group. I've got a series of slides. I'm not a PowerPoint guy, but there's some really critical slides that you're going to be left with in print form that are going to lay out these strategies so you can actually walk with them. Agents are even welcome, but you got to pay me $300 if you want that secret sauce. I'm looking for sellers out there right now who are looking to potentially make a move in the next 6 months, but are afraid to death about what that might look like. And little tease, these guys across from the table right now are actually part and parcel to that strategy, because one of the key things is, if you're planning on buying again, is the type of pre-approval you have waiting for you on the other side. That's one secret. You're going to want the other 6.5 by going to my website. It's greenmeansgrow.com/Jesse. And you can click on my name and say, I want in on the next Sell Then Buy workshop, please. So that's it, gang. I appreciate you guys hanging out. This has been The Secret Stash on Real Talk Radio San Diego. We'll be back next Tuesday between 1 and 2. In the meantime, check these guys out. You can catch them at greenmeansgrow.com/David and greenmeansgrow.com/Jeremy. We'll see you guys next week.